When we decided to hold another gold summit to prepare investors for 2025, the first name on our list of guests was Jim Rickards. His CV is like something out of a Tom Clancy novel. He's been in the room, as it were, for many of the turning points in financial, geopolitical, and economic history. From the collapse of LTCM to the Pentagon's first economic war games to the CIA's response to terror financing, Jim has the inside story because he was there. As a lawyer, investment banker, media commentator, newsletter editor, and author on matters of finance and precious metals, he now shares his views and predictions with investors who want the insights of a former insider. Jim's latest project is to predict the impact AI will have on investing, money, and financial markets with his book, Money GPT, AI and the Threat to the Global Economy. In this interview for the Gold Summit, Jim lays out his 3 reasons why gold will continue to rise in 2025. Jim sees gold as the everything hedge for an increasingly uncertain world. That's ironic given his track record of making accurate predictions. But if even Jim needs to own gold to protect himself from rising uncertainty, you do too. Our host Nick Hubble has been working with Jim Rickards since 2017, so who better to introduce you?
Jim Rickards, thanks very much for joining us. I can't help but wonder where you might be in the world because sometimes you're very difficult to keep track of. So tell us where you are.
Well, thanks, Nick. I'm in the mountains of New England. It's a place I call the Fortress of Solitude. I live mainly in New Hampshire, but I'm up in the mountains now, so it's very, very quiet, nice place to be.
How's your solar array that you've built performing?
Well, as you can probably see behind me, it's a sunny day, so it's working fine right now. I've become a bit of an expert on solar power. I always explain to people, say, oh, you run on solar power. I said, actually, no, we run on batteries, but the batteries are charged by the solar power. So yeah, it's a system, but you're running off batteries. And it works fine unless it's, snowing, raining, or at night. So it doesn't work at all. So you have to, the key is really having enough batteries to store the power for the rainy days. But my point is you actually learn a lot about adaptive behavior. So, and it's not difficult, but it's like any learning experience. So a day like today, again, you can see it's quite sunny. It's the morning where I am. This is the day to run the washing machine, the dishwasher, the dryer, the hair dryers. It's all the electronic appliances just go full blast because it is a use it or lose it environment. And then on a snowy day, if you don't have as much power or you're low, we have monitors. That might be the day to, put off the laundry for another day. But it's not, my point is, it's not difficult, but you do learn to kind of work around or work with, I should say, the elements because you're relying on those. But then the other learning experience is my system. It's the biggest private system in New England. Now, towns and businesses have larger systems, of course, but for a single residence, it's the biggest. But it's a 7.25 kilowatt hour, so decent amount of output. But I had to clear 3 acres of land to do it. I get people, like from Arizona, like, why do you need 3 acres of land to put up we have 9 towers is the amount we have. I said, well, we have something in New England you don't have in Arizona. They're called trees, and they fall down. you don't want trees falling on your towers, so you need to clear, an extra perimeter, obviously, but that takes up a little bit of land. But then I say, well, gee, given the infrastructure, the investment, the amount of land you need, et cetera, to run one house, how on earth are you going to run cities, with solar power? The answer is you're not. It's a supplement. I'm not against it. As I say, I own the system, but it's not highly scalable, and it's not the solution to a lot of these net zero fantasies and so forth. But it's interesting. Yeah. But the short answer is it works fine.
Yeah. Well, that's the short answer. But the point is that you've discovered the hard way the weakness in the argument of net zero. It's the opposite of being a hypocrite, isn't it? You've done it, you've tried it, for a fact. It's difficult to argue with you now.
Yeah, well, that's right. I didn't. By the way, I didn't build it to save money on my electric bills. I won't live long enough for that to happen. But I really built it to be robust to a power grid failure. So it's not about it's not about CO2 or climate change or any of that. It's about, can you have electricity and can you survive in a world where the power grid is extremely vulnerable, which everyone agrees it is. We're just waiting to see what happens on that front. But I also have a fairly large amount of land. I'm in the middle of nowhere, so I have a lot of trees, and trees are a CO2 sink. Trees take in CO2 and put out oxygen, which I've always thought was a good thing. Given the fact that the trees are a CO2 sink, and I have a solar power system, so we're not generating any emissions to power the house, I have a negative carbon footprint. So I don't have to put up with any grief from Greta Thunberg or John Kerry or any of these people. I think I have a better CO2 footprint than they do. I'm sure of that.
Yeah, it's such a confusing situation, but I can't imagine why you're worried about blackouts, Jim. All right, let's dig into gold here. So when I asked you for what your top catalyst for gold is in 2025, I can't say that I am at all surprised that you gave me more than one. It's very much your style. So let me read them out here. The first one is central banks, especially BRICS members, are net buyers. The second is gold is the everything hedge for an uncertain world. And the third is that gold is not going up at all. It's the case that the dollar is going down. Let's take those in reverse order, if I might. It's very intuitive for people in the last 4 years to understand that it's not gold going up. It's the value of the currency going down. But take us through the actual argument that explains what's happened.
Sure. And, in addition to, obviously, I study gold and follow it very closely, and markets in general, whether I invest in them or not. Some I do, some not, but I'm always writing about them for our readers. And gold's had a great run recently. We all know that. We can look at the tape. It's hit a series of all-time highs. It ticked up to 2,800 per ounce. It's off that a little bit, but that's normal. Nothing goes in a straight line, so you have ups and downs. But gold is, in the vicinity of its all-time highs. So exactly, people say, gold, went from 1,800 to 2,200 and 2,700 and 2,800. And I said, no, what you're witnessing, that is true from a data perspective, but what you're witnessing is the collapse of the U.S. dollar. Now, people ask me all the time, partly because of my book, Currency Wars, and for other reasons, how's the dollar doing? And I say, well, it's getting a lot weaker. They go, wait, what are you talking about? The euro is down to 106 and the yen's pushing, approaching 159, and the yuan is blowing through 722, and the Bloomberg index is 105 heading to 106. Looks like the dollar is as strong as ever. I said, well, it depends what you're comparing it to. One of my favorite jazz songs, it was a great live version performed at the Montreux Jazz Festival in 1969, but the song is called Compared to What? And when people say, how's the dollar doing? I say, compared to what? Now, that's a little bit my law school training. You answer a question with a question. But the point is, if you're comparing it to the euro, yes, the dollar is very strong. The same thing with sterling and Canadian dollars and a lot of other currencies. But if you use gold by weight as your measuring stick, then the dollar actually is crashing. So the question is, what is your metric? And I prefer gold for a couple of reasons. It's not that I'm a gold bug. Yeah, I own gold and I recommend it, but I'm pretty hard-nosed about valuation and how much you should have and all that. But when you look at DXY, which is the leading U.S. dollar index, and there are others, Bloomberg and so forth, you're comparing currencies to currencies, dollars to euros, euros to yen, and so forth. But they're all in the same boat. I say the vessel sank. They're all in the same lifeboat. They may survive, but they may all sink together. But they're not going their separate ways. There's not going to be a world where the dollar has collapsed by some measure, and everyone says, "Oh, get me the euro," or get me the Aussie dollar or whatever. They're all going. If there's that kind of stress, they're all going to fall together or be sustained together. So those differences, they're important for currency traders. They're important if you're in the import-export business. Or if you just want to speculate, there are reasons why you would pay attention to it. But as a measure of trust or reliance or faith in the dollar or dollar strength, you're comparing like to like, and you're not really getting an objective measure. To me, gold is that objective measure. It's not a currency. It's a form of money. It's a store of wealth. Serves those roles very well, but it's not something it's not like 1910 where I could get on the the steamship in London with a purse of British sovereigns and get off the boat in Shanghai and spend them like they were money. They were money. That was absolutely true in that day. The sovereign was a quarter ounce, 8 grams, basically. So you can't do that today. But as a store of wealth in the form of money, as a monetary asset, that's what it is. But it's not a central bank currency, and it's not a liability. If you study the history of money, and I know you have, most money, various money at various times, is basically the government giving their debt to a bank and the bank issuing bank notes, which is just bank debt. I mean, I tell people, Americans, but I think it's true around the world, take a 20, in our case, a $20 bill out of your wallet or, 20-pound note or whatever, and read it. I was taught that in law school. Read the contract. There's a contract between the government and the citizens, and it says Federal Reserve note. Well, where I went to law school, a note is debt, and indeed it is. Go to the Federal Reserve website and look at the balance sheet, and you'll see all the currencies on the liability side of the balance sheet. So most money is basically governments giving central banks their debt, and then central banks giving them something you can spend. Gold is not issued by a central bank. It's not a liability. It's not a note. It's an element, atomic number 79. So to me, it satisfies the requirements of an objective, if you will, an objective measure of value that's not more of the same. So again, just to summarize, when I see gold going from 2,000 to, it'll make its way to 3,000, you can call it a 50% increase, but you can also call it a 50% crash of the US dollar.
There's a real division between people who understand this and people who don't, and it can take some time to get it. A book I recently read, which featured actually some of the history of money, explained it in a really interesting way. So there was this revolution in science when scientists, astronomers started to realize that the Earth was moving through the universe in and of itself. So all of the astronomical observations that astronomers make have to be adjusted for the fact that the Earth is moving as well. And it's sort of the same with cash, right? Every stock market chart, every budget, every house purchase, it all has to be adjusted for inflation. Inflation is not stable. It fluctuates a lot in and of itself. So it's really just a terrible measure over time. And although gold is not perfect, it's a lot better. And how does thinking about the world in terms of gold instead of currencies, once you've made that change, how does it change your outlook about what you want to invest in, what you want to do in your life?
Well, Nick, you're absolutely right about stock indices. I'll come back to gold in a second on that observation. The best case I can think of is in 1969, the Dow Jones Industrial Average. That today the S&P is kind of used by portfolio managers, but in those days it was the Dow. In 1969, the Dow Jones hit 1,000. It then crashed, up and down, volatile rallies and declines. But we had a severe recession and stock market crash in 1974. I graduated from college in 1973. I guess I wasn't ready to have a job. I went to grad school, but all my friends went to Wall Street, and then they were, euphoric and great Christmas parties and all that. I saw them all a year later, and they were all unemployed. I was too. I was a student, but it was an interesting time. But the Dow did not hit 1,000 again until 1982. So you had a 13-year period. It went down, up and down, but it took 13 years to recover the old high. So you say, okay, 13 years, we made it back. No, you didn't, because during that period, inflation was well over 50%. So the 1,000 in 1982 was only worth about $500 in 1969 dollars, if you want to think of it that way. So 13 years to get back to your nominal high, and you're only halfway back to a real high. So that's the kind of thing to bear in mind. But that's true today. In fact, I just saw a study, I believe it was done by an economist or researcher at Deutsche Bank, but I saw it was in Bloomberg, so you can find it online pretty easily. And it said the same thing. Today, U.S. stocks, every day, Dow at an all-time high, S&P 500 an all-time high, et cetera, et cetera. Happy days are here again, buy stocks. And it said, actually, no. If you adjust for inflation, because we have had the highest inflation in 40 years. In June 2022, inflation was 9.1%, and that, year over year. Okay, it's come down a little bit, but it's still relatively high. if you adjust for inflation, gold has outperformed stocks. This particular study was 25 years, okay, a quarter century from 2000 to 2024. That's not a small sample. That's the other thing that drives me crazy when people do comparisons. I'm like, well, you have a 2-year time series. Can we do 10 years at least? This was 25 years, which I thought was interesting. And it said gold and other commodities have outperformed stocks in the last quarter century when adjusted for inflation. So first of all, your point is well taken. Gold is robust to that. But I'm calling gold the everything hedge. People, I think when you say it's an inflation hedge, which it is, you're not giving gold enough credit because gold has done well in the past year. Inflation is higher than it has been for a while, but it's not. It was screaming in 2022. This is U.S. data. I know it varies by country, but pardon me. It was. It's been higher than it should be, but moderate for the past year. But gold is surging anyway, so it tells you there are other factors in the gold rally other than just inflation. So is it an inflation hedge? Yes, but to say, well, gee, I'm going to buy gold when inflation comes along. Okay, but you might be missing out. In fact, you are. The data says you are missing out. It's a hedge against geopolitical uncertainty. It's a hedge against sovereign risk. I happened to have shared an office with Myron Scholes for 6 years. He was very generous with his time. He used to come into my office on slow days and give me, I would ask a dumb question and he'd give me like a private tutorial. So I see options in my sleep. But part of the Black-Scholes, he won the Nobel Prize for the Black-Scholes formula, options pricing formula. But part of it says the U.S. Treasury bill is the risk-free rate. You need the risk-free rate, past performance. There's a little bit of Ito's calculus thrown in for good measure, but the risk-free rate is a key element of that. My question for Myron or anyone, I haven't seen Myron recently, but would be, ask the Russians if they think U.S. Treasury securities are risk-free. The U.S. not just, in 2022, at the beginning of the special military operation in Ukraine, we froze $300 billion worth of Russian-owned, lawfully purchased U.S. Treasury securities. Now we're in the process. Freezing is one thing. The U.S. is very good at that. Ask Iran and a bunch of other places. But now we're in the process of stealing them, working with most of those securities, by the way, 200 billion of the 300 billion of Russian-owned U.S. Treasury securities are on the ledger at Euroclear, which is the largest clearing firm in Europe, which has $40 trillion of assets on its ledgers. But we're in the process of converting 50 billion of that into as collateral for a loan to Ukraine to perpetuate the Ukrainian war. So here, Russia earns the reserves lawfully by selling energy and other exports. They lawfully buy U.S. Treasury securities. They're in a war in Ukraine for a lot of other reasons, and the U.S. is stealing the assets to finance the war against Russia. So again, don't talk to me about risk-free rates. There's risk everywhere. Why has Russia not collapsed? I mean, actually, the Russian economy is outperforming the U.S. economy, has since the beginning of the special military operation. Russia's biggest economic problem right now is they can't find people to fill all the factories. I mean, their economy is booming, so they have an employment issue, but it's not unemployment. It's they can't find enough workers. They're doing extremely well. Why has the economy not collapsed? Well, there are a lot of reasons, but one of them is Vera Nabiullina, who's the head of the Central Bank of Russia. I always describe her as the only central bank in the world who knows what she's doing. Put 25% of their reserves in gold, physical bullion in Russia. So at the going back to 2022, round numbers, Russian reserve position was $600 billion, but $150 billion of that was in gold bullion. And then, of course, much of the rest was in Treasury securities. But the reserve position was never wiped out because they weren't completely, fortunately for them, not relying on the U.S. Just an ironic footnote to that, because of the impact of U.S. sanctions and because of the rally in gold, while the U.S. is busy, stealing the Russian Treasury securities, Russian Federation has booked a $50 billion mark-to-market profit on the gold, because with a given quantity of gold, when gold went from about 1,800 or so, now close to 2,800. Take that increase in dollar value, and their gold reserves have gone up $50 billion. So, so much for depriving Russia of its reserve positions, actually making profits on the gold. So, but the point being, there's a case where it had nothing to do or little to do with inflation, everything to do with geopolitics, and that's why I call gold the everything hedge. It hedges a lot more than just inflation.
Jim, why does someone with your track record of making predictions and your contacts, your experience, need an everything hedge? Surely you know exactly what's going to happen next.
Well, gold's going to go higher because the dollar is going to go lower for the measured by weight of gold. I should be clear about that. And so you say, okay, that's a statement. What are the facts to back that up? What are the trends? What's the data behind that? The biggest single factor, and it's bigger, I'll talk about BRICS in a minute, but it's bigger than BRICS, is from 1970 until 2010, central banks were net sellers of gold, starting with the United States. Everyone, August 15th, 1971, Richard Nixon shut the gold window, stopped the convertibility of U.S. dollars by foreign trading partners into gold. By the way, they said, and I've spoken to two of the participants, two of the people who were at Camp David that weekend when Nixon made that decision, Kenneth Dam and Paul Volcker. Paul passed away, but just to confirm my understanding, I said that was meant to be temporary, right? Because Nixon said temporary. You can find his speech. And they said, yes, absolutely. We wanted a timeout. We were going to have another monetary conference, devalue the dollar against gold, and then go back to the gold standard. That was the plan. They called the timeout. They did devalue the dollar against gold from $35 an ounce to $42 an ounce. They did have the monetary conference at the Smithsonian in December 1971. But the only problem is they never went back to the gold standard. But that was the plan. But throughout the rest of the 1970s, the U.S. continued to dump gold on the market. Kissinger was involved in this to kind of defend the dollar. But finally, in 1980, the U.S. stopped. We haven't sold any material amount of gold since 1980. There are reasons for that we don't have time for. There's a whole mystery going back to when Roosevelt took the gold from the Federal Reserve and gave it to the Treasury. And the Treasury, under the Fifth Amendment of the U.S. Constitution, you can't steal take property without giving just compensation. Our Constitution requires that. So what was the compensation that the Treasury gave to the Fed, which is privately owned, for the gold that they took? The answer was it was a gold certificate, which is still on the balance sheet. But if you do the math, it's not difficult. It's on the books at $42 an ounce. If you revalue to, just the market, it's around $26.50 today. And multiply it and figure out, well, how many ounces do you need to back up that certificate? The answer is almost exactly what the U.S. holds, which is 8,133 metric tons. Just convert that to ounces. So query whether the Treasury is in effect legally prohibited from selling any more gold because it has to keep that amount to back up the certificate. That's a monetary mystery, but kind of just circle that a little bit. So what did we do? Well, in the late 90s, we suckered the British into selling half their gold. They did at $250 an ounce, by the way. That was Gordon Brown was the Chancellor of the Exchequer. It's known as Brown's bottom. But he did manage to sell the gold at the absolute, that's like a 60-year bottom. So nice job, Gordon Brown. Then in the early 2000s, we put pressure on the Swiss, and the Swiss sold 1,000 metric tons between 2000 and 2009. Finally, the Swiss rose up in a peaceful revolt and had a referendum, and the Swiss National Bank said, no mas, no mas, we're not selling any more gold, and they haven't. And we got the IMF to sell, I think, 400 tons in 2010. That's it. No more suckers. And so 2010 was the year the inversion took place where central banks became net buyers. And they've been net buyers ever since. And the buying is accelerating. Russia has quadrupled its gold reserves from 600, this is 15 years. Russia has gone from 600 tons to 3,000 tons. China, about the same, 600 tons to 3,000 tons that we know of, could be much more, but also Iran, Turkey, Philippines, Kazakhstan, Mexico, Vietnam, if you go down to India, even Japan somehow pulled 300 tons, probably in the back room, but we've restated their gold reserves from 600 tons to 900 tons. This is all by weight, by the way. I'm not talking about dollar valuations. So, so what that does, if you're an investor, it's my favorite kind of trade. It's called an asymmetric trade. You have a kind of floor, no guarantee. But if central banks are buyers and continual buyers, and they don't try to gobble up all the gold in the world at once, the market's very liquid, but not that liquid. Russia is a good example. 10 tons a month, 20 tons a month. You know, it's a little engine that could, but you do that for 15 years and you're going to get thousands of tons. But they kind of put a floor under things, which means you can buy. It doesn't go up the next day, but if the trend is up and there's a floor that keeps it from going down because the central banks come in and maintain the floor, that's a beautiful thing. And so so that's one trend. Now the BRICS have accelerated that because they are in the process of they're doing a couple of things at once. They're coming up with their own currency, but very slowly. We might not see that for 10 years. And people say, well, they can't do it and all that. Well, I remind them that the Maastricht Treaty was signed in 1992, and the euro was not available until 2000. That took 8 years to figure out. I know Alberto Giovannini is one of the scholars who worked on that. And so, look, if it took the Europeans 8 years, I imagine it would take the BRICS, which is a little bit more of a polyglot kind of organization, just as long. By the way, the biggest issue in Europe and the euro was the conversion rates. I mean, you got Italian lira, French francs, German Deutschmarks. So, how would you value them all relative to each other? The purpose of saying, okay, lock it in. Here's the euro. That took a while because the Italians wanted a little better valuation. The point being, that will take a while. But what is not taking a while, what is happening in real time, and a lot more progress at the BRICS Leaders Summit in Kazan, Russian Federation, that just took place a little over a month ago, is they've come up with their own payment system. And they're going to use their own currencies transacting in a closed circuit, meaning secure payment system. So, Russia will ship energy to China and get paid in yuan, and yuan will China will ship manufactured goods to Brazil and get paid in rice. And if you want to buy, if India wants to buy Embraer aircraft, et cetera, they'll pay in rupees. So there'll be all these do tos and do froms. The way you handle it in the real world is you keep a ledger. Now the central bank comes in and pays all the sellers in local currency. And then they absorb the due from the trading partner on a central bank ledger. That's what this, it's called BRICS Clear. That's what this system will maintain. But you have to settle up every now and then. But the thing is, you can settle up on a net basis, not a gross basis, which means there's far less money moving back and forth because you're going to get credits for the things you sold to pay for the things you bought. You don't have to settle up in real time. You can, but you can settle up quarterly, let's say. So a quarterly net settlement is not that onerous. And how can you do that? Gold. In other words, if in the absence of your own currency, your own BRICS currency, which is some years away, you can use gold as the coin of the realm, so to speak. And you can move it. You just put it on a plane and fly it around, but you don't have to. Again, as long as you have a ledger, I'll say, well, I'll clear all my debts to you in gold by weight. And you can measure it in yuan or rubles or anything else. And it was interesting to note that along with this BRICS Clear system I just described, they're coming up with a commodities exchange. Again, it's all non-dollar denominated. There are no dollars in this whole system, but gold plays a very significant role because it is the only common currency of the now at the moment 9 members, but probably on its way to 20. They green-lighted, I believe, 17 new members. It's kind of like joining a club. You don't become a member overnight. You got to do the application, go for the interview and all that stuff. But they greenlighted a bunch of applicants, and they'll be adding members. So that monetary and trading union is going to expand. But the only common currency is gold. So again, whether you're just any old central bank that wants a reserve that's not a U.S. Treasury because we're in the habit of stealing them, or you want something that you can use for net settlement with your trading partners in the absence of a common currency and dollars, gold is very much in demand.
It feels like BRICS plus all these different countries, they're doing everything except launching this currency. They're accumulating gold, they're setting up commodity markets, they're doing these deals, they're setting up their organizations like the BRICS. Why are they avoiding this one particular issue of launching their currency? And when do they actually do it? And is that the moment, the big moment that we've all been waiting for, when, the US dollar gets into big trouble and, it's all a big crisis?
To answer the first question, I would say they already have their common currency. It's called gold, that which we just went through. So they don't need somebody actually printed up a BRICS, I don't know what they call it. It wasn't a dollar, but, one brick or whatever, like a note, and they gave it to Vladimir Putin because he was the president of the conference. They've already solved that problem with gold, number one. So it's already happened, which is why you can be very bullish on gold. Number two, the currency will come along in due course. As I say, the euro took 10 years. Let's give the BRICS, give them a break, give them 6 or 7 years to figure all this out. But the secure payment system and the ledger, and it's a digital ledger, by the way. It's not a cryptocurrency. It's not a central bank digital currency yet, but it is an encrypted digital ledger. That's what they're building, and that's what they're unveiling. So I would say I wouldn't sit around waiting 10 years for the BRICS currency. I would say they're doing it now. And if you said, what's the common denominator? It's gold.
Yeah, but they haven't announced the fact that they're going to be using gold to do the net settlement. What triggers that moment, and what's the response to it?
Well, again, I think you just have to understand the monetary system. If it's not gold, what is it? And as far as is there an aha moment, or what some economists call a Minsky moment, when all of a sudden there's a repudiation of the dollar, everyone's dumping U.S. Treasury securities. You don't need that. What happened, I think a better case study is sterling. So in 1913, sterling was the undisputed global reserve currency. Gold was actually money at the time. You might have some Bank of England notes, that's convenient, but you could just as easily carry a purse full of sovereigns, a quarter ounce British gold coins. And no one doubted that. But beginning with World War I, you could almost pin or pick the beginning of the demise of sterling. It was November 1914. Of course, the war started in end of July, early days of August 1914. But initially, the UK, and actually all the belligerent powers, so it's true, Germany, Belgium, France, didn't matter what side you were on, they were all dumping U.S. securities, selling stocks. They actually closed. The New York Stock Exchange was closed from August to December 1914. If people say that can't happen, I was like, well, it did happen, because people were just dumping stocks, real estate, but they were getting gold, shipping the gold to Europe so they could have it in their vaults because they knew they would need it to fight the war. And actually, when the German submarine attacks got too dangerous, the Bank of England opened a branch in Canada. And New York bankers sent whatever gold the British had earned by selling securities. It was sent by train from New York to Toronto. Might have been Ottawa, but in any case, it was in Canada, and they stored it there so they didn't have to move it across the ocean. So, but then it was all downhill for sterling from there, because once they got the gold, they had to use it to buy weapons, ammunition, clothing, agricultural output, supplies, et cetera, much of which they bought from the United States. So we sent them all the gold because it was theirs, but then we got it all back because they needed it to finance the war. That was the beginning of the end of sterling. Now, it didn't completely get buried, didn't put the last nail in the coffin until Bretton Woods in 1944. Sterling's still a reserve currency today, but it's about 3 or 4% of global reserves. It's not a big slice. But the point being, that happened over 30 years. It didn't happen overnight. but the trends were in place and you pay attention to the trends. So I would say the move away from the dollar has already started. It doesn't have to be dramatic and it doesn't have to take 30 years. The fact is it's in train, it's happening, and it's a good reason to have gold.
I was going to suggest to you that the transition from America will be very different because it was sort of a very peaceful and a transition to an allied power. But I suppose it's not really in anyone's interest to cause trouble in the global financial system, least of all China and Russia and so on and so forth.
Well, yeah, well, China still has over $1 trillion of U.S. Treasury securities, so it's not in their interest to trash the dollar, and Russia, has some hope of getting theirs back once we have peace with, the ceasefire peace treaty with Ukraine. And again, that is what happens. We froze Iranian assets in 1979 at the time of the hostage crisis, and then kept freezing them and kept sanctions. But eventually, Biden basically gave them all their money back. So these things have a way of working out. But if you saw, just in recent times, in 2000, the U.S. was 70% of global reserves. Well, global reserves were denominated in U.S. dollars. You don't have stacks of $100 bills in the basement of the central bank. You have U.S. Treasury securities. But using the dollar as a numeraire, in 2000, it was 70% of global reserves. Today, that number is 59%. And the euro is like 26%. So you take U.S., the dollar and the euro together, they're 85% of global reserves. And then there's 7 or 8 other countries, Aussie dollars and Swiss francs and sterling and yen and they kind of yuan. Even they have small slices of the remaining 15%. So you don't have to trash the dollar. If that number certainly falls below 50%, I think 50% is one of those critical thresholds where the perception changes. Like economically, going from 50 to 49 is not the end of the world, but psychologically it may be in some sense, and then the BRICS will come along and take their share. So it's more, I think it's important to understand the dynamics. But if I'm saying, the BRICS currency will come along in due course, it'll grow, the dollar will shrink, the euro will shrink, et cetera. What's constant? What's the common denominator? It's gold.
Let's move to the recent US election, because I'm very curious what you have to say about what Trump's influence on all this is going to be, especially the fact that the US under Biden has basically used this weapon of the US dollar. It was one thing to have the threat. They've gone and used it. It's activated this move away from the dollar. What's Trump going to do? Is he going to try and shoot the same gun twice? Does he understand that it's probably not a great idea? Right. I find him very unpredictable. You're very good at predicting what he's up to. So tell us what his administration is going to do about these sorts of things.
Sure. Well, a few things are more obnoxious than patting yourself on the back, but if I could just drop a footnote, our flagship newsletter, Strategic Intelligence, came out at the end of October, and we said Trump and Vance were going to win. We said Trump would get 312 electoral votes, would get 54 Senate seats, and 224 seats in the House of Representatives for the Republicans. The actual numbers were 312, so we stuck the landing. Looks like 53 Senate seats instead of 54, so couldn't get much closer. Maybe it looks like 222 House seats. We said 224. So basically, we had a near perfect forecast. It was the best forecast out there. You had big names like Nate Silver saying too close to call. And what good is that, Nate? I mean, you're just you're throwing up your hands. New York Times, Economist. Actually, the Economist had Kamala Harris winning. So much for that. And a lot of them were just too close to call. But we were categorical, and we completely nailed the metrics. And the only reason I mention that is because we have a model. I mean, I didn't just pull numbers out of a hat. We had a model which performed very well. It looks at polls. I'm not a pollster. I'm an analyst. We look at polls, but that's just one input among many that we use to get those kind of results. So I think our track record speaks for itself. Much easier to predict what Trump's economic plan is going to be because he's been very transparent about it. If you know Robert Lighthizer and Peter Navarro and Donald Trump and Scott Bessent is a new name, but could well be our Secretary of the Treasury. It hasn't been announced as of the time we're doing this interview. They've all said what they're going to do. We're going to put high tariffs on major trading partners, particularly China.
What about Trump's use of the US dollar as a weapon? Do you think he's going to use the threat, or actually use the sorts of sanctions and confiscation that was done to Russia to anyone else?
I don't think so, and I'll tell you why. It's a very powerful weapon used at the right target. Now, here's again, people are kind of blunt, just like black or white, yes or no, etc. I happen to be an expert on sanctions, and a lot of the work I did for the intelligence community, for the CIA, involved economic warfare and the use of sanctions, and studying intelligence collections on foreign investment in the U.S. Was it good or bad, dangerous? Not from an economic point of view, but from a national security perspective. And I teach this at the U.S. Army War College, and the sanctions do work. They can be powerful against a country that meets three criteria. One, you don't have a lot of friends. You're a little bit isolated for other reasons. You don't have a large amount of reserves. You actually need the trade, and you basically don't have any workarounds. You don't have any alternatives to whatever it was that's being sanctioned. So, and kind of a medium-sized country. So Iran was a perfect target. They didn't have a lot of friends. It's a large country, but we're not talking about Russia, China, Brazil, and they didn't have a lot of reserves. So we put sanctions on them, going back to the Obama administration, 2010, 2011. They worked. I mean, we got the Iranians to the bargaining table. The fact that Obama did a lousy deal doesn't alter the fact that the Iranians came to the table. And then Trump very wisely tore up the deal and then tightened the sanctions. And we weren't, I had a debate with a treasury official once. I said, why did you keep going? We were on our way to regime change without firing a shot. Nobody wants, color revolution or boots on the ground, but we were kind of winning the financial war. And he said, well, we got them to the table and that was our goal. Fine. But Trump tightened them even more. And guess what? They weren't shooting missiles at Israel. The Houthis were not closing the Red Sea and the Suez Canal. Hezbollah was not on the warpath. None of those things were happening because we were putting the screws to Iran. And then when Biden took them off, the whole place is in flames. So there's a lesson there. But the point is, sanctions work against Iran. They don't work against Russia. They don't work against China. When you're that big and you have that many reserves and you have it in gold and you're exporting things where there's no price elasticity. You got to buy it: oil, natural gas, strategic metals, agricultural goods, wheat, etc. And you're the 12th largest economy in the world, and the largest landmass in the world, and the largest nuclear arsenal in the world, and a decent-sized population. You're strategically located from the Pacific to the Baltic. You can't get pushed around, and the Treasury has found that out the hard way. Because those sanctions, we put 13 rounds of sanctions on. Well, what are you going to do, 14? I mean, they don't work. Russian economy is booming. Russia is outperforming the United States, et cetera. And so, and I've been talking to some, Trump transition people, and they kind of get it. So the short answer is I would not expect sanctions of the kind we've seen to be applied against Russia and China, simply because they don't work. It's not like we're nice guys. It's not in the U.S. interest. I would expect them to be applied to Iran, where they can work. So there is this nuance of, are you pushing around a little kid or a big kid? Well, they're two different results. Having said that, tariffs are not sanctions. Tariffs are an economic tool. They're as American as apple pie. It was only beginning in 1962 that the U.S. got into this whole free trade globalist, encasement mindset, which is the Austrians, von Hayek and Hayek and von Mises and others, run wild. But beginning with Alexander Hamilton, through John Quincy Adams, Abraham Lincoln, William McKinley, all the way up to Dwight Eisenhower, U.S. was a high tariff country, and look at the result. We had a strong military, a prosperous economy, and a lot of technological innovation, et cetera. So I expect a return to that. But again, tariffs are not economic warfare. They're economic policy. Sanctions, freezing, seizing, et cetera, that is economic warfare. But choose wisely when it comes to your opponent.
Yeah, they're just a tax policy as well. Let's finish with something totally different to gold, which is your new book about artificial intelligence and the impact it is going to have on pretty much anything an investor might want to know about. So can you give us a brief synopsis? Tell us when the book is out. Tell us what we should know about it.
Thank you. Well, the book's out now. We're just celebrated the publication date the other day. You can order it online, Amazon or other leading booksellers. We Barnes and Noble, but around the world there are a lot of online outlets. But I think Amazon is number one, or in bookstores. We're in. We've already done 7 or 8 foreign languages, so they'll be coming out soon in German, Japanese, Chinese. A few Arabic, a few other languages, but I think the English will be the most widespread, and certainly they read that in Australia and in the UK and all the Commonwealth countries. In the Middle East, actually, is a big English language market. So yeah, thank you. It's Money, GPT, AI, and the Threat to the Global Economy. And we're not bashing AI. AI is, first of all, very powerful. Secondly, it's here. It's not some it's coming, it'll be here in a few years, watch out. No, you open your refrigerator door and there's a light that says change the water filter. That's AI. I mean, there's a semiconductor in that refrigerator. It's measuring, it has a clock and it's measuring humidity and it's telling you what to do. So that's AI. It's on the dashboard of your car, Alexa, Siri, larger systems, behind the curtain, on the internet. You don't even know it's there, et cetera. So it's everywhere. Number one. Number two, it's very powerful. And it can do a lot of good. There are cases where, how do you develop new drugs, new treatments in the pharmaceutical industry? Well, one of the ways is you look at all the molecules, and various combinations can produce certain effects, and of course you have to test them and all that. But now a room full of geniuses with lab equipment and enough time can find some of those. But an AI computer can find them in hours or weeks or maybe months, not years and centuries. So, and there have been some, promising cures and treatments that have already come out of AI systems that humans are like, gee, I never would have thought of that. Well, that's right. That's the benefit of it. But that said, I stay in my lanes, which are capital markets, banking, and national security. So I kind of give a nod to all the other, engineering and medicine, and that's all true. But the book is about those particular categories. And the point I make, there are, of course, stock markets are being driven by the AI frenzy. So, NVIDIA and Microsoft and Apple and Meta, Facebook, Google, all the rest. It's not really about the stock market, whether that's a bubble or not. Take your pick. People have different views on that. But it's really about the potential impact on individual investors and markets as a whole. Now, one example I use, and I'll kind of circle back to AI, but imagine you're at a football game and you don't have a great view because the person seated in front of you is either too tall or they're wearing a big hat or something. So you go, well, I know the answer. I'll stand up. You stand up and, gee, now I have a great view. It's fantastic. I can see all the action. Well, what happens next? Well, the person behind you stands up and the person behind her stands up. And pretty soon the entire stadium is on their feet. Nobody is better off because you have the same relative view you had before, and everybody's worse off because you're all standing up. That's called the fallacy of composition. What it means is that something that works for an individual, that might be a very good idea for an individual, fails catastrophically at scale. You can't scale it. Now, how does that sort of translate over to the stock market? Well, let's say stocks are crashing, and they do. In March 2020, the stock market fell 30% in 1 month. It was not the largest crash in history, but it was the fastest crash of that magnitude in history. They'd never fallen that far that fast in a very short period of time. What do people do? Well, human nature, you watch it for a couple of days, like, it'll come back, whatever, and then it doesn't. And you're like, okay, sell everything, go to cash, move to the sidelines, wait until it bottoms out, and then when it does, when you're comfortable, tiptoe back in and catch the next wave up. That's a perfectly good strategy for an individual. We work hard to make money. We sure don't want to lose it. And so that strategy works for an individual. But what happens when you do that at scale? You have a world where we have all sellers, no buyers. The market goes straight down. You blow through the circuit breakers. You go through the floor, and then you shut the markets and query whether they reopen anytime soon. So that's an example of a good individual strategy that fails at scale. Now, what is and that's human nature to some extent. That behavior's been around forever. But when you add AI to it, so the idea that all these engineers are coming up with all these different algorithms, it's not true. I mean, there's some coding differences. They're all doing the same thing. And think about what you're doing when you're an AI engineer, artificial intelligence. By the way, Nick, there's nothing intelligent about artificial intelligence. It does not resemble the human brain at all. It mimics the human brain, but it doesn't work like a human brain. And I'll come back to that. But anyway, it does what it does. But you're trying to mimic the human brain. So you're mimicking the exact behavior that I described. And then what's different about AI? Well, it's self-learning, it's deep layered, you have layers of input output nodes, and you have inputs, which are data, and then it's processed and node, then that output becomes the input of the next layer, and you work your way up to final probabilities and conclusions, etc. Where's that system learning? It's learning from what's called the training set. The training set is all the written material in the history of the world.
Jim, you're giving too much away. You're giving too much away. There's going to be nothing left in the book.
Oh no, trust me, there is. there's a lot in the book. I'm trying to give an example that is perhaps most important for the individual investor, but there's a lot else. But the point being, the machine learning is from a training set of human behavior. That's exactly what I described. So all the algorithms are the same. So the AI, it's all going to behave the same. So the point is, we're primed for a market collapse. Nobody sees it because everyone's got the pom-poms out there like, yay, AI. And again, it is powerful and useful, but it has, it amplifies and accelerates human behavior. And if human behavior is prone towards panic, which it is, and you're harnessing an AI system to the market, which amplifies and accelerates that, you're going to get the worst panic you've ever seen. And I just want investors to be aware of that and to prepare for it. Could it happen tomorrow? Yes. It doesn't have to. It could happen next month or next year, but it will happen, and you need to understand it and prepare.
And every new technology that's made it to market has had a similar effect at one point or another. So there's that track record. But if you want to understand, everyone at home, why this one is going to happen regarding AI, then I can only encourage you to read Jim Rickards' book. Jim, thanks very much for joining us.
Thanks, Nick.